3.5%. For someone in the top tax bracket, that's like earning 6% on a taxable bond. This tax advantage is a game changer. For someone in the 37% federal bracket, a 3.5% muni yield equals a 5.55% taxable yield. Add state taxes, and the equivalent yield jumps even higher. California Munis, for example, offer tax-free income at both federal and state levels. A huge deal for high earners in expensive states. This tax break becomes even more valuable if rates rise further. And here's why it matters. State governments are in their best financial shape in decades. Rainy day funds are at record levels, and tax revenues have been strong. State and local governments have built up $136 billion in reserves, 50% more than before the pandemic. This cushion matters when economic storms hit. But not all states are equally prepared. Texas has enough reserves to run for 90 days, while Illinois can only cover 15 days. These differences highlight why location matters when picking munis. But before you jump in, there's a catch. Not all munis are created equal. Remember Detroit's bankruptcy in 2013 or Puerto Rico's debt crisis? These cases show that even tax-free bonds can blow up if you're not careful. The key is knowing where to look and what to avoid. Vanguard's municipal bond team recommends essential service revenue bonds, things like water systems, toll roads, and airports. These services generate steady cash flow regardless of the economy. General obligation bonds, which rely on a government's promise to pay, are riskier. If tax revenues drop, those payments could get squeezed. Pension liabilities remain a major risk. Some cities have promised more than they can deliver. Chicago's pension funding ratio sits at just 45%, and Los Angeles faces $10 billion in unfunded liabilities. When pensions eat up more tax dollars, there's less left for bond payments. That's why revenue bonds, insulated from these pension issues, are often the safer choice. Default rates show that munis are generally safe. Over the past 40 years, the 10-year cumulative default rate for investment-grade munis is just 0.1%, compared to 2.25% for corporate bonds. Even during the 2008 crisis, muni defaults stayed low. Most defaults were concentrated in risky sectors like nursing homes and speculative projects. Stick to essential services, and your risk drops dramatically. Liquidity has improved since the 2020 panic. Back then, muni markets froze and prices plunged. Today, trading volumes are healthier, and ETFs have made it easier to buy and sell. Still, individual bonds often trade infrequently, which is why many investors use mutual funds or ETFs for instant diversification and daily liquidity. Interest rate risk remains a concern. Like all bonds, munis lose value when rates rise. Vanguard suggests a barbell approach, mixing short-term munis for stability with some longer bonds for yield. This balances risk while keeping tax-free income flowing. The supply-demand picture also looks favorable. Muni issuance has dropped 20% from 2020 peaks as many governments built up cash reserves. At the same time, demand remains strong from high-net-worth investors seeking tax shelters. This imbalance could support prices even if broader bond markets weaken. For families looking to protect their savings, municipal bonds offer a rare combination of safety, tax advantages, and steady income. Tips: inflation insurance or trap. Tips look like the perfect inflation hedge on paper, but the reality is more complicated. Imagine a rising escalator. The principle of tips adjusts upward with inflation, like the escalator moving higher. But at the same time, real yields, interest rates adjusted for inflation, can act like a downward pull, dragging the value of existing tips lower. This tug-of-war creates a scenario where tips can lose value even as inflation climbs, especially if real yields rise sharply. Currently, 10-year tips price in just 2% annual inflation over the next decade, which seems optimistic given that core CPI has been stuck above 3% for 2 years. If inflation runs hotter than expected, tips should provide some protection. However, rising real yields can still lead to losses. For example, in 2022, tips lost 12% despite high inflation because real yields spiked. This double hit, sticky inflation and rising real yields, can make these safe bonds riskier than they appear. Morgan Stanley's fixed income team analyzed this dynamic during past market swings. They point to the 2013 taper tantrum, when real yields surged and tips underperformed, and the 2022 bond market sell-off, which saw similar results. Their advice? Focus on short-duration tips with maturities under 5 years. These are less sensitive to rate changes while still offering inflation protection. The sweet spot seems to be 2 to 3 year tips, which balance yield and risk effectively. The break-even inflation rate is a key metric for evaluating tips. Right now, 10-year tips imply 2.3% average inflation. If you believe inflation will exceed that, tips could be a good deal. But if inflation cools faster than expected, regular treasuries might outperform. With shelter costs still rising 5% annually and wage growth above 4%, the Fed's 2% inflation target seems increasingly unrealistic. Liquidity is another factor to consider. The tips market is smaller than the regular treasury market, which can lead to bigger price swings during periods of volatility. For instance, during the March 2020 crash, tips spreads widened significantly as sellers struggled to find buyers. ETFs like TIP and SCHB can help with liquidity, but they may trade at premiums or discounts to their net asset value during turbulent times. Tax treatment adds another layer of complexity. Tips generate phantom income, as their principal adjusts upward with inflation, meaning you owe taxes on that increase each year, even though you don't receive the cash until maturity. This makes tips less appealing in taxable accounts, but less of an issue in tax-deferred accounts like IRAs. The Fed's balance sheet policies also impact tips. When the Fed was buying $1 trillion per year in treasuries and MBS, it suppressed volatility across bond markets. Now, as the Fed reduces its holdings, price swings have become more pronounced. With the Fed owning about 20% of outstanding tips, their selling could put additional pressure on prices. Corporate inflation-linked bonds exist, but carry more risk due to credit exposure. During the 2008 crisis, even strong companies saw their inflation-linked bonds plummet. Government tips remain the purest inflation hedge, despite their quirks. Historical performance shows mixed results. Tips outperformed regular treasuries from 2003 to 2008 as inflation fears grew, but lagged from 2009 to 2019 when inflation stayed low. The past 3 years have been volatile, with big gains in 2021 followed by steep losses in 2022. This unpredictability makes timing critical. For most investors, ETFs offer convenience despite minor roll yield costs. Individual tips held to maturity avoid this issue, the looming stall speed danger. The economy is hitting what pilots call stall speed. That critical moment when an airplane is moving too slowly to stay airborne, but too fast to land safely. Imagine a plane struggling to maintain altitude, its engines straining as turbulence shakes the cabin. That's where the U.S. economy finds itself now. GDP growth dropped to 1.6% last quarter, while core inflation remains stuck at 3.8%. This precarious balance leaves the Federal Reserve with no easy options. Cutting rates to boost growth risks reigniting inflation, while hiking rates to fight inflation could send the economy into a nosedive. The New York Fed's recession probability model now shows a 27% chance of contraction within the next year. While not unprecedented, it's double the odds from last summer. More concerning is the trend. Each month, the needle inches closer to danger. The last time we saw this pattern was in 2007, just before the financial crisis. Back then, bond markets also signaled trouble, with yields dropping months before stocks peaked. Today, the bond market is flashing similar warnings. Corporate earnings are another red flag. S&P 500 earnings growth slowed to just 3% last quarter, down from 10% a year ago. Revenue growth has dropped even further, from 5% in 2022 to just 1.5% now. Companies are relying on cost-cutting to maintain profits, but that's a short-term fix. When earnings stall, layoffs often follow, and we're already seeing early signs of this in the tech and finance sectors. Consumer spending, the engine of the U.S. economy, is sputtering. Retail sales growth has slowed to 1.5% annually after adjusting for inflation. Credit card balances have hit a record $1.13 trillion, while the personal savings rate has plummeted from 8% during the pandemic to just 3.2% today. Americans are running out of financial runway, and that spells trouble for growth. The labor market, while seemingly strong, shows cracks beneath the surface. Job openings have dropped 30% from their peak, and temporary help services employment, a reliable leading indicator, has declined for 12 consecutive months. Wage growth is also slowing, down from 5.9% in 2022 to 4.1% today. This pattern mirrors 2007, when employment metrics weakened just before the recession hit. Manufacturing data adds to the bleak picture. The ISM manufacturing PMI has been in contraction territory for 16 of the last 18 months. New orders, a forward-looking component, remain in decline. Historically, factory activity weakens before the broader economy, and right now, it's flashing bright red warning lights. Housing markets confirm the slowdown. Existing home sales are at 13-year lows as mortgage rates approach 8%. Builder confidence has plummeted, and housing starts are down 15% from last year. Since housing often leads the economy, this weakness will ripple through related industries like construction and home improvement. Even the bond market is bracing for impact. The 10-year per 2-year yield curve has been inverted for 18 months, longer than before the 2008 crash. Credit spreads are widening, and high-yield bond defaults have doubled since last year. These are classic late-cycle signals that growth is faltering. So, with the economy teetering on the edge, what happens when external shocks, like tariffs, add to the turbulence? Let's explore that next. The tariff wildcard. Just when inflation was starting to cool, new tariffs threatened to send prices climbing again. The Biden administration recently announced sweeping new tariffs on $18 billion of Chinese imports, including electric vehicles, solar panels, and semiconductors. Economists estimate these import taxes could add 0.5 to 1% to inflation if fully passed through to consumers. While that might seem small, it's enough to keep inflation stubbornly above the Fed's 2% target. Think of these tariffs like a sudden storm disrupting a calm market sea. During the 2018 trade war, similar tariffs on Chinese goods pushed core inflation up by 0.3 percentage points. Washing machine prices alone jumped 12% in just 3 months. This time, the storm targets clean energy products critical to Biden's climate agenda, creating a contradiction. Policies meant to fight inflation may end up driving prices higher. Bond markets reacted immediately. The 10-year Treasury yield jumped 0.15 percentage points the day the tariffs were announced, a significant move in the typically steady Treasury market. Investors clearly see tariffs as inflationary, signaling higher rates for longer. The 5-year break-even inflation rate, a key gauge of inflation expectations, also ticked up after the announcement. The ripple effects could extend beyond prices. The 2018 trade war showed how quickly tariffs can scramble global supply chains. Companies relying on Chinese components faced shortages, delays, and costly redesigns to avoid tariffs. This complexity added expenses that were ultimately passed to consumers. The new tariffs could trigger similar disruptions, particularly in clean energy supply chains. China has already promised retaliation, threatening tariffs on U.S. agricultural exports like soybeans and pork. During the last trade war, such measures cost U.S. agriculture $27 billion in exports and pushed food prices up by 2%. A repeat of this dynamic could hurt American farmers and further strain household budgets. The auto industry faces unique challenges. While the 100% tariff on Chinese EVs is largely symbolic due to low import volumes, the 25% tariff on lithium-ion batteries could raise costs for U.S. automakers. Most electric vehicles rely on Chinese battery components, even if assembled domestically. Ford estimates these tariffs could add $1,000 to the cost of an average EV, making the transition to clean energy vehicles more expensive for consumers. Solar installations may also slow. The U.S. imports about 80% of its solar panels from Southeast Asia, much of it from Chinese-owned factories. The new tariffs could raise costs for solar projects by 10 to 15%, potentially slowing progress toward Biden's goal of 100% clean electricity by 2035. Higher costs mean fewer installations, ironically hindering the energy transition the tariffs aim to support. Semiconductors are another flashpoint. The U.S. is imposing tariffs on Chinese chips even as it invests billions to build domestic capacity. But building semiconductor factories takes years. In the meantime, tariffs could raise prices for everything from smartphones to cars. The Philadelphia Semiconductor Index dropped 3% on the tariff news, reflecting market concerns. For investors, the implications are clear. Higher inflation means the Fed will likely keep rates elevated longer. Traders have already pushed back expectations for rate cuts this year, with the probability of a September cut dropping from 70% to 50% after the tariff announcement. This creates emotional stakes for portfolios, as higher rates could pressure corporate bonds, particularly in sectors like autos and solar, where margins are already tight. Commodities, however, could benefit. Tariffs often lead to stockpiling of raw materials, driving up prices. Copper and lithium prices jumped on the tariff news, while gold rose as investors sought inflation hedges. These moves suggest markets expect tariffs to fuel broader price pressures. The political calculus is tricky. Tariffs poll well with voters concerned about Chinese competition, but higher prices could backfire closer to the election. The Fed faces a tough choice. Cut rates to offset tariff impacts and risk letting inflation run hot, or stay firm on inflation and risk accelerating an economic slowdown. Either way, the stakes for markets and portfolios are high.